It's time now for some Squawk picks. Our next guest says the key investments for the chip industry are exposure to AI, electric vehicles, and wafer fab equipment. Joining us to talk more about the chip sector is Vivek Arya. He is Bank of America Global Research Senior Semiconductor Analyst. Vivek, thanks for joining us. I guess as we look for the second half of the year, do you expect that the leaders in the chip sector from the first half of 2023 will continue to lead going forward? I know NVIDIA is one of your top picks. It's up something like 190% year to date. So I guess you assume it will still play in these key areas and continue to lift the sector going forward for the rest of the year?
Good morning. Thanks for having me. So I think the semiconductor industry is going through some very interesting cross currents. On the challenging side, consumer demand is sluggish. U.S. demand is sluggish. We have seen Europe go through its own issues. China is also going through a weak phase right now. But at the same time, there are a few green shoots where there are major technology disruptions. And we are in the first year of what could be a multi-year period of where we could benefit from these technology disruptions. And we call them the 3 C's of semis: cloud, cars, and complexity. So cloud is investments in generative AI, cloud computing. That's NVIDIA, that's Broadcom, that's Marvell. Cars is the secular move to electric vehicles that require 2 times the number of semiconductors. That's ON Semiconductor, that's analog devices, microchip, and others. And then complexity is really the rise in complexity of chip making. That's names such as Applied Materials, Cadence, and Synopsys. So our call is really to be selective. It's to focus in these 3 areas: cloud, cars, complexity, where we think there is enduring technology disruptions that are happening.
Vivek, I'm surprised that your 4th C is at China. I was kind of surprised it wasn't one of your top 3 C's there. How do we factor in the financial implications of what's going on in China? And it just seems like there's more and more export restrictions when it comes to these chip makers.
Yeah, absolutely. I think that, any friction between the largest designer of semiconductors, which is the U.S., and the largest buyer of semiconductors, which is China, they're never good. Friction in a global industry is never good. But at the same time, one has to realize that U.S. has a lot of leverage in this economic tension, right? So a lot of the major pieces of IP are resident in the U.S. And a lot of the output from the U.S., so the chip designs, serve as inputs for one of China's most important industry, which is electronics. So let's look at the most recent issue, which is the tensions because of gallium and germanium. There are multiple sources that are available for these specific materials. They're only used in a handful of semiconductors. And in many cases, the chips that are produced using gallium and germanium are actually inputs to electronics that are assembled within China. So that's why we think that we have to look through some of these headline issues. But I do agree with you that over the longer term, tensions between these 2 countries is never good for a global market such as semiconductors. But we do think that in the near to medium term, many of these headline issues are actually quite manageable.
I want to talk a little bit more about the potential for AI with some of these names. How much of what we expect in the innovation in this area is already baked into some of these valuations? And how much more upside could there be that is not already priced in?
Sure. So, the bull case scenario for AI is that we are in the first year of what could be multiple years of changing and transformation of nearly $1 trillion in data center infrastructure from traditional computing towards accelerated computing that's requiring the use of AI. That's where NVIDIA is at the forefront of driving that change. But I do think every 6 months to 12 months, there is going to be a report card of investments that have been made, whether they are monetizable. Technology is not the bottleneck here. I think it's really the ability of cloud players to monetize this technology. As it relates to valuation, I think one has to realize that technology stocks don't move up or down because of valuation. There has to be an appetite to own technology stocks because of market conditions, interest rates, and so forth. But once that condition is met, it's really about the size of the market. It's about competitive positioning. It's about the company's execution, profitability. And that's the reason we pick NVIDIA, because despite it trading at 40 to 45 times next year earnings estimates, we think that the market for its products is large and growing. its execution, it's outstanding. Its competitive position, it's outstanding. And if I go back 2 years ago, when the company was trading at the same valuation, the stock went on to generate another 30 to 50% returns back in 21, and then another 30 to 50% returns back in 2020 at exactly the same valuation. So we don't think valuation is going to stand in the way of these stocks doing well, as long as some of these other boxes are checked, which we think in NVIDIA's case, they absolutely are.
So just to wrap that up with a fine point, so you think that the economic conditions are going to be right to own some of these stocks in a growing environment macroeconomically going forward?
Yeah, absolutely, because I think semiconductors are the building blocks of this digitization of the global economy, whether it is in cloud computing, whether it is in the move to more energy efficient infrastructure, whether it's in cars or the basic infrastructure. It's also, driving the demand towards more smarter devices. There's a lot of operational expense benefits. It's not just a CapEx benefits and OpEx benefit. So we do think semiconductors are the basic building blocks of the global economy. So in that growing economic environment, the demand for semiconductors, we think, will outpace the growth of the global economy.